I've officially opened up an RRSP, or a Registered Retirement Savings Plan. Now, if you've been following along, then you'd know that I started my investing journey with my TFSA that I maxed out earlier this year. Then I opened up an FHSA and I maxed it out for now earlier this summer, and now I'm officially opening up an RRSP next. Now, I have 3 main financial goals that I'm working towards. Investing as much as possible while I'm young, also increasing my income as much as possible. Dennis and I have definitely been focused on increasing our income streams and have been over the last few years. And then the last one is also buying real estate. Ideally an investment property first, that's still a TBD for now, but eventually a place for us to live into. So that's why I chose to use my TFSA first, so I could start investing as much as possible for retirement, and then my FHSA next, so that I could start putting some money towards saving for a future house one day. And now I'm finally moving on to my RRSP so that I can continue to invest for retirement. And I'm also using this account now that I actually have a higher income than I did over the past few years while I was working on maxing out my TFSA. The other thing that you would know if you've been following along with my investing journey is that earlier this year, I officially switched over from using a robo-advisor to instead investing completely by myself using a DIY or self-directed approach. With the robo-advisor, I didn't have any control over what ETFs I was purchasing. Now, I was able to select the highest risk level, which was an 11 out of 10 on that platform, which basically just meant that I was investing in all equity ETFs, or ETFs that had stocks in it, and then those all equity ETFs were diversified geographically. So the robo-advisor had me purchasing 6 or 7 different ETFs, and once I switched over to investing on my own, I knew that I wanted a simpler option so that I didn't have to purchase that many different funds and also be constantly rebalancing them. So once my TFSA was transferred to the self-directed platform, I decided to purchase an all-in-one ETF instead, and I specifically went with XEQT. Now, XEQT is an ETF made up of 4 other ETFs. So there's ITOT, which covers the US market, XIC, which covers the Canadian market, XEF, which covers developed markets, and XEC, which covers emerging markets. So when I purchase XEQT, I'm paying iShares, which is the company or ETF provider that sells XEQT, to do the work of balancing and rebalancing those 4 underlying ETFs to their set levels. Anyways, I'm telling you this because XEQT is what I decided to invest in inside of my TFSA, and right now, as it currently sits, my TFSA is maxed out, and all that's in there is shares of XEQT. Also, if we take a look at my portfolio, you can see my TFSA limit's actually $69,500, but my account is currently up 11.14% all time right now, so it's actually sitting at $76,768. Now, after that was maxed out, I moved on to my FHSA, and I also decided to invest in XEQT inside of that investment account too. Now, make sure you check out the other videos that we did that go all in depth into why I made that decision, but for now, my FHSA is also maxed out for the year. And if we take a look at my portfolio again and my FHSA specifically, my limit for the year is $8,000, but right now my account is up 4.81%, so it's sitting at $8,384 right now. My plan is to not touch the money inside of my TFSA until retirement, so decades from now, and then to use the money that's inside of my FHSA to buy a home in the future, probably in about a decade. Now, my RRSP is the last type of registered or tax-advantaged investment account that I'm able to use, and I'm really excited to start using the contribution room that I've been accumulating over the past several years. Now, I plan to use my RRSP for the same purpose as my TFSA, which is long-term investing for retirement. So the money that I invest inside of this account, I don't plan on touching for several decades, which means that I have a long time to contribute to it and also to allow that money to grow before I touch it. Because of that, I already knew that I wanted to stick to purchasing all equity ETFs inside of this account. Now, to explain that a bit further, when you're younger and are many years away from retirement, you have the ability to invest in all equities and not diversify your portfolio by asset class. This means that I don't have any bonds or any fixed income investments in general inside of my stock market portfolio. Instead, I'm focused on all equity investments so that I can focus on the growth of my portfolio and grow it in value as much as possible. Now, with that being said, I still stick with passive and diversified ETFs by making sure that they're diversified geographically and also by sector and industry, so that I'm not overly invested in one part of the stock market. So since I'm using my RRSP in the same way that I'm using my TFSA, I knew that I wanted to purchase a similar type of ETF, meaning all equity but geographically diversified. However, I also knew that I wanted to start reducing the amount of home country bias that I have in my overall portfolio. If you haven't heard of this term before, home country bias is investing a higher percentage of your investment portfolio in investments from your home country than you should be according to the global weighting scale. Since I live in Canada, home country bias for me would be investing more than 2 to 3% of my investment portfolio in Canadian investments, which I currently am within my TFSA and FHSA. You might remember that when I was breaking down the holdings inside of XEQT, Canadian stocks makes up about 25% of that ETF, which is obviously a much higher percentage than 2 to 3%. Now, home country bias is something that happens all over the world. People tend to favor investing in companies that are from their own country. Now, studies have been done in Canada specifically that show in the past, investors have actually had approximately 50% of their investments in Canadian investments specifically, which is obviously very high. Now, there's a lot of information to cover when it comes to home country bias, but one thing that I want to point out is that different countries are made up of different sectors. So in Canada, for example, a lot of our large companies fit within only a few different sectors, like financials, energy, and materials specifically. So we don't have a lot of large tech companies or really any other sectors. So if you have a really high Canadian home bias, you're not only limiting your geographic diversification, but also your sector diversification too. Now, the more I learned about this, the more I realized that I wanted to reduce the amount of home country bias that I now had within my portfolio. I personally feel like 25% is a little bit higher than needed. Now, with that being said, after doing some research, I decided that I still wanted to stick with XEQT with my TFSA and FHSA for a few reasons. The first is that I'm currently looking to invest in CAD-listed ETFs. Now, an ideal ETF, in my opinion, is VT because it's based on the global world weighting scales and also it has really low fees, but it's USD listed, meaning that if I wanted to purchase it, I'd have to convert my CAD to USD first, which is something that I'm just not interested in doing right now. The second is that the closest or most comparable CAD-listed ETFs to VT all have much higher MERs. So for example, XWD, it has an MER of 0.48%. So XEQT, although it does have a higher percentage of Canadian stocks, still allows me to have geographic diversification within one fund. It has slightly lower fees because the MER is 0.2% and it's CAD listed. So I decided that I'd continue to invest in XEQT within my TFSA and FHSA, and then I'd invest in a different ETF inside of my RRSP to reduce my Canadian percentage in my overall stock market investment portfolio. So what ETF did I go with? It actually took me quite a bit of time to decide, but after a lot of research, I learned that there's actually 2 CAD-listed ETFs that mostly follow the global world weighting scale. Now, I say mostly because they do, except they completely exclude Canada. So inside of them, there's US market stocks, developed market stocks, emerging market stocks, but 0 Canadian stocks. So essentially, they're international ETFs excluding Canada. Now, you might be wondering, why would you want an ETF that excludes Canadian stocks? Good question. Well, in my case, as I'm already looking to reduce the percentage of Canadian stocks that I have in my portfolio, it made sense to me. I'd be continuing to invest in just one single ETF, which helps keep things simple. It would also still be geographically diversified, and I'd also be slightly increasing the percentage of US stocks I have in my overall portfolio and slightly decreasing the amount of Canadian stocks I have in my overall portfolio, bringing both of those countries closer to the actual allocation they should have according to the global world weighting scale. So that's what I decided to purchase within my RRSP. Now, the 2 ETFs are very similar to each other, but one's offered by iShares and one's offered by Vanguard. Here's how they compare to each other. Okay, so the first one is VXC, and it tracks the Vanguard FTSE Global All Cap Excluding Canada Index ETF. Now, the MER for this ETF is 0.22%. Its percentage of US stocks inside of it is about 63.6%. And I'm also going to list some of the other details, including the specific holdings, because this is an ETF made up of other ETFs inside of it. So I'll list the breakdown of that on screen as well. The second ETF is XAW. Now, this one tracks the iShares Core MSCI All Country World Excluding Canada Index ETF. It also has an MER of 0.22%. Its USA percentage is 64.4%. And again, it's an ETF made up of other ETFs, so I'll have some of the other details on screen, along with the specific ETFs this ETF holds. Now, you can see that these 2 ETFs are very similar. The only real differences come from the fact that they're offered by 2 different companies, so the underlying ETFs that these ETFs hold are specific to those companies. So for example, Vanguard's VXC holds other Vanguard's funds inside of it, and then iShares XAW holds other iShares funds inside of it. Now, I did read one article that did an even more in-depth comparison of VXC and XAW, and it does turn out that XAW is actually a little bit more actively managed. Basically, the funds that they wanted to hold inside of this ETF didn't actually exist, so the way they went about selecting which stocks would be included came down to a board of people who actually actively selected them. Anyway, it's a really interesting read, so we'll link the article down below if you're interested and you're actually debating between these 2 ETFs, but the main TLDR is that they're very, very similar. That was the tiebreaker for me though, so my official decision is to start purchasing VXC instead of my RRSP. Now, one thing that I do want to mention that's specifically relevant to the RRSP is that at a certain point, it actually does become mathematically worth it to invest in USD listed ETFs inside of this account. In general, there's 2 main reasons why buying USD listed ETFs can be too expensive for Canadian investors, even though the MERs tend to be much lower. The first is that we have to pay currency conversion fees in order to actually convert our currency from CAD to USD so that we can purchase the USD listed stock. Unless, again, you're doing Norbert's Gambit, which, like I said before, is something I'm not interested in doing right now. And the second is that we have to pay a 15% withholding tax on dividends from US stocks. Now, with an RRSP specifically, you'd still have to pay the currency conversion fees, but you wouldn't have to pay that withholding tax on dividends from US stocks held within USD listed ETFs. That's because the US and Canada has a tax treaty in place that actually reduces that percentage down to 0% for RRSPs specifically. Now, there have been studies done where they've done the math to see if it's actually more cost effective to purchase USD listed ETFs, and it's not up until a certain point, which is somewhere around $200,000 that you have invested inside of your RRSP. At that point, the cost savings that you'd get from the lower MERs and the 0% withholding tax start to offset the currency conversion fees that you'd pay. Now, keep in mind that this is a very high level explanation of this. I'm just simply trying to explain why I'm personally sticking with CAD listed ETFs for now among all of my different investment accounts. So I'll potentially revisit this in the future, especially as my RRSP specifically starts to grow in value. But for now and for the foreseeable future, I'll be investing in VXC, which is a CAD listed ETF inside of my RRSP. So with all of that being said, I officially opened up my RRSP in July and I invested $32,000. Now, if you're wondering how I invested that much money to start off with, let me explain. At the end of last year, Dennis and I were able to pay ourselves out a bonus of about $20,000 each. Now, some of that I'd already invested earlier this year into my TFSA to help max that out, and then the rest of it I had sitting in a high interest savings account until now, at least earning some interest until I knew what I wanted to do with that money. But now that I had room in my RRSP and I knew what I wanted to invest in, which is VXC, I decided to put the rest of that money towards this account. So on top of that chunk of money, this past June, I also received an inheritance from my grandpa. Now, this is obviously a personal and more like touchy subject to talk about, but my grandpa passed away at the end of last year from cancer, and he left some money for my brother and I, which I'm obviously very grateful for. I really debated talking about this on here, but you guys know we're always really transparent with our money. I wanted to make sure I included it, even if it is a bit more of a sensitive and personal subject. Obviously, an inheritance isn't something that everyone gets. It's obviously going to make a big impact on my investing journey as well, so I wanted to make sure I mentioned it. So another chunk of the money came from that as well. Then on top of that, I also included my typical monthly contribution of $2,000, so all of those things combined brought me up to the $32,000 number. Now, since it's September, I've also already added another $2,000 for my August contribution, bringing me up to a total of $34,000 contributed to my RRSP. Now, if we look at where my portfolio is actually sitting today, you can see that it's up 1.19% all time so far, so my account's sitting at $34,403.90. And I'm going to continue to contribute $2,000 a month for the next 4 months that are left of this year, meaning that I should be able to contribute $42,000 to my RRSP in total in 2024. And then next year, I'll start the year by revisiting and remaxing out my TFSA and FHSA before getting back to my RRSP later in 2025. So that's a wrap on me opening an RRSP and also my RRSP investment strategy. Now, I definitely want to hear what you guys think about this down in the comments below, so make sure that you let us know down there. And remember that we'll be back next week with another video.